So go to question 21. Or May, June, right?
Yeah,
May, June 2021. Accounting. They said, how should inventory be valued? You're talking about inventory, right?
Yeah.
Inventory should be valued based on the low cost. Do you want to buy an inventory that is the cost is higher? Then how do you sell it? So inventory should have a low cost. So lower of cost and net realizable value. And when we talk about net realizable value, we're talking about the estimation of your closing inventory. So use NRV to estimate your closing inventory. So whenever you talk about an inventory, you should measure it based on the lowest cost it's possible. You don't get inventory at a higher cost. How do you make sales? How do you make profit as a business? So the cost should be low, and you have to estimate the closing inventory through your NRV, net realizable value. Clear?
Yeah.
So the answer is C. Question 22. James is an accountant and operates as a sole trader. Which item would not appear in the statement of financial position? He's going to have a long-term loan. That's normal. Retained earnings. When we talk about retained earnings, how is he going to have? He doesn't have a retained earnings. He's a sole trader. He has profit or retained profit, not retained earnings. Retained earnings goes for companies. Companies, PLCs or limited companies.
Yeah.
So retained earnings is not there. Then trade payables is a service business. It doesn't have suppliers. Is it clear?
Yes.
So the answer is D. 2 and 3 are not part of his financial statement.
Yeah.
Question 23. Zaha is a consultant who receives fees from clients. How would Zaha calculate his profit for the year? It is fees received divided minus expenses.
Yeah.
Do you get that?
Yes.
So Zaha is a consultant who receives fees from clients. How would Zaha calculate his profit for the year? Profit will be fees received minus expenses. So that's D. Question 24. What is added to owner's capital to calculate capital employed? The formula for capital employed is owner's equity plus non-current liabilities. That's how you get your capital
liabilities.
Yeah, non-current liabilities. You get not current liabilities, non-current liabilities.
Yes.
So capital employed is owner's equity plus non-current liabilities. Is it clear?
Yeah.
That's question 24. Question 25. What is an advantage of forming a partnership? Decisions have to be recognized by all partners. That is disadvantage of partnership.
Yeah.
Each partner is responsible for actions of other partners. That's a disadvantage. Profit have to be shared among the partners. That's another disadvantage. Share of responsibilities.
Yeah.
That's D. So the only advantage here is 25, which is in 25 is D. The 3 other options are disadvantages of partnership.
Yeah.
Clear? So 25 is D. 26. Anne and Ben are in partnership, sharing profit and losses equally. They provided the following information for the year ended 30th April 2021. Profit for the year is 20,000. Interest on capital for Anne is 5,000. For Ben is 4,000. Drawings for Anne 8,000. Ben 7,000. What was Ben's share of residual profit? Note, they shared profits and losses equally, right?
Yes.
So we are told to find residual profit. For residual profit, it is the amount of leftover from the operating profit, which is from when you are able to calculate the cost of using capital for that transactions. I'm going to say it again. I wrote the amount of leftover operating profits after paying all costs of capital used to generate revenue. So you would have used equipment, you would have used capital to generate the revenue, right? Mm-hmm. So what is the cost on that capital that you use in generating revenue? You less it from your operating profits. That gives you a residual value, residual profit. Did you get it now? Yes. So here we have our interest on capital to be 5,000 and 4,000 each. Yes or no? Yes. So that is the value of capital used to generate that profit. Okay. So 5,000 plus 4,000 is 9,000. 9,000 minus the profit is our residual profit, because this is that's capital minus the operating profit. So that's 20,000 minus 9,000. which is
Okay.
11,000.
Yeah.
And profit is
Yeah.
being shared equally. 11,000 divided by 2. That's 5,500.
Yeah.
Is it clear?
Yes.
So the answer is A. Question 27. Which statement about receipts and payments account is incorrect? It includes amount prepaid at the end of the year. Yes. 2. It shows the surplus for the year. No. It shows the balance, the closing balance for the year. That means it shows what debit balance or credit balance. It gives us a debit balance if we have more, and gives us a credit balance if we have overdraft. So because a receipt and payment account is basically the cash account.
Yeah.
But for non-current, for non-trading organizations. So whatever you get here is what you take to your income statement, to your income and expenditure account.
Yeah.
You get what I'm saying? So income and expenditure account has net surplus or net deficit, not receipt and payment account. Receipt and payment account has a closing balance. Do you get that point?
Yes, sure.
So that's the first thing. The second one is it shows the answer is B.
Okay.
So the third question says the third option is non-monetary items are excluded. In your receipt and payment account, it is about cash and bank balances. It does not include non-monetary items. Do you get what I'm saying here? In your receipt and payment account,
Yeah.
it is about cash and bank balances. You don't include non-monetary items like assets.
Assets.
Yeah, you don't include them.
Yeah.
So that's why they said non-monetary items are excluded, which is right.
Yeah.
About receipt and payments account. Then the balance represents cash and bank balances. Yes.
Yes.
Do you understand? Because I told you earlier that as soon as your receipt and payment account is done, the balances go to your income and expenditure account.
And there will be a deficit or surplus.
Yeah, debit or credit.
Yes.
Is it clear?
Yes, yes,
So the answer is B, 27. 28. How does the manufacturer calculate prime cost? You know prime cost already. Direct material plus direct labor plus minus direct expenses.
No, plus. Yeah, plus for all.
No, direct material, direct labor plus direct expenses. Yes, sorry.
Yeah.
Direct expenses, sorry. So it's B. Question 29. Nula provided the following information for the year and then 31st of March, right? 31st of March 2021. Yeah. What was the profit or loss for the year and then 31 March 2021? Drawings for the year was 3,900. Net assets at the beginning of the year was 60,500. Net asset at the end of the year, which is the closing net asset, is 72,275. So how do you calculate profit here? First, you have to put it in mind that drawings represent the amount of cash or assets withdrawn by the owners of the business from the business. Yeah. That's what drawings represent. So if it's during the year, you have to add it to your net assets.
If it's during the year.
Yes, you have to add it to your net assets.
If it's in the end, you have to less.
You less it. Why? This is the reason, because profit will be made by the business. We want to calculate the profit. So if you are calculating the profit, you have to put in mind that the owner of the business has capital.
Yeah.
As a result of that, if the owner of the business has capital, you have to less capital, not add capital anymore. That's why you have to add profit. It has to be of a two-way thing. So if you're going to add capital, if you're going to less capital from profit, you have to add drawings plus to profit. Did you get it? Mm-hmm. The owner of the business has injected cash into the business or assets into the business. So that means when the profit is made, you have to less that amount from it. Yes or no? Yeah. So if the owner of the business withdraws cash or asset from the business, you have to add it to the profit. Because at the end, yes, you can't do the opposite. Because at the end of the day, the drawings will be added because capital will be deducted. Yeah. Do you understand? Yes. So if you don't add profit, you would have understated your profit.
You don't add profit.
Yes, you would have understated your profit. If you don't add drawings, yes, you would have understated your profit. Do you understand? Yes. Owner's capital, owner's equity or capital will be deducted from profit. So what would drawings be? You want to deduct drawings again? No. It's a double entry thing, right? Yeah. So if you are adding capital, if you're going to deduct capital from profit, you have to add drawings to profit. Yes. So here, our profit or loss will be closing net asset minus opening net asset plus drawings, which is 72,275 minus 60,500 plus
So
3,900
closing minus opening and then add the
plus
other.
drawings.
Yes.
So that's 15,675 profits. Is it clear?
Yes.
So D. Question 30. A trader provided the following information: cost of sales for 80,000, expenses for 4,000, profit for the year for 16,000. What was the profit margin? Here we're talking about the net profit margin. So the first thing you have to do is to find what net profit is. And the formula for net profit is gross profit minus expenses. Yes or no?
Yeah.
But we are given expenses, we're not given gross profit. So that means net profit is gross profit minus expenses. That means net profit, gross profit will be net profit plus expenses.
Yeah.
So net profit plus expenses gives us 20,000. So that means gross profit is 20,000. Gross profit is ascertained now. We'll move on. Now we need sales because we cannot calculate profit margin without knowing the sales, because profit margin is net profit. Net profit margin is net profit divided by sales multiplied by 100. So now that we know gross profit, we need to find the sales. We're not given sales, we're given cost of sales. Note, gross profit is sales minus cost of sales. So if gross profit is sales minus cost of sales, that means gross profit will be, sales will be gross profit plus cost of sales.
Yeah.
So gross profit is 20,000, sales we don't know, plus cost of sales, which is 80,000. So our sales will be 80,000 plus 20,000. So our sales is 100,000. Clear, right?
Find the sales now.
Yeah, sales, the value of sales now is 100,000.
Yeah.
So from here we can find the net profit margin, which is net profit divided by sales multiplied by 100. Our net profit now is what? 16,000, right? Divided by sales, which is 100,000 multiplied by 100. That's 16%.
Yeah.
Is it clear?
Yes.
That's A, question 30. Okay. Let's see. Together.
Yeah.
So, question 31. A trader provided the following information: revenue 3,600, revenue 3,600, opening inventory 100, purchases 2,600, closing inventory 300, and gross profit. Then it was found that the closing inventory should have been 400. So our new closing inventory is 400. That's the point. So what is the formula for rate of inventory turnover? The rate of inventory turnover is cost of goods sold divided by average inventories.
Cost of goods sold
Divided by average inventory. That is the rate of inventory turnover.
Yeah.
Are you with me?
Yes.
So what's our cost of goods sold? Our cost of goods sold is opening inventory, add purchases, less closing inventory.
And the list, so it's going to be.
So our opening inventory is 100, purchases is 2,600. Then you less closing inventory, which is now 400.
So 2,300.
That's 2,300. That's clear, right?
Yeah.
Our cost of goods sold is 2,300. Then we said we need to find the average inventory.
Yeah.
Average inventory is opening inventory plus closing inventory divided by 2.
Yeah. Yeah.
Average inventory is opening inventory plus closing inventory divided by 2.
Minus.
No, it's plus.
Yeah.
So opening inventory is 100, closing inventory is 400 divided by 2. That's 500 divided by 2, which is 250. So the rate of inventory turnover is cost of goods sold divided by average inventory. Cost of goods sold is 2,300. Average inventory is 250. 2,300 divided by 250 is 9.2 times. So the answer is C. Is it clear now?
Yes.
Question 32. Sally's business has reached. Okay. Sally's business has reached the overdraft limit set by the bank of 1,500 and is not able to pay its debt when the fall dip. Sally is considering the following proposals. First, Sally is owing a short-term loan. Is owing a short-term loan. So, because you are owing a short-term loan and they said is trying to wants to improve his working capital.
Yeah.
So if you're having a short-term loan, you are finding difficulty in paying them. So what I'm saying is this: Sally is having a short-term loan. If you're having a short-term loan and you are finding difficulty in paying them, that means, and you at the same time you are thinking about improving your working capital. So if you have to improve your working capital, the first thing you can do, which is the most suitable and easier, is for you to take money from your own personal account
Yeah,
to put into the business account.
just capital.
Capital, add capital to the
Yes.
business. If not, you can try a long-term loan, which you are going to pay at a long period of time, because you already have a short-term loan that you are unable to pay the debt. Do you understand?
Yeah.
So for you to improve your working capital as an owner of a business, is either you put your own wealth into the business or you seek for a long-term loan. Do you understand?
Yeah.
So based on what we have here, they said Sally is considering the following proposal, asking the bank to increase the bank overdraft limit to 2,000. It's not going to be possible. If that would be possible, interest will be charged more.
Mhm.
And it's even finding difficulty to pay its debts. So right now, the bank will be considering Sally as high risk. They wouldn't want to give that.
It's irresponsible.
Yeah, it's high risk. They wouldn't want to give to. Two, borrowing 2,000 from a relative and paying the money back in 6 months. A relative, it's difficult.
Yeah.
It's a bit difficult to find your relative to give you such amount. And you are even having issues.
Yeah.
And because you are having issues paying a short-term loan. So how are you going to be able to pay in 6 months, which is another short term?
Mhm.
So it is not a good idea. So 1 and 2 is off it.
Yeah.
Then obtaining a loan from the bank for 2,000 repayable in 2 years. That's the long-term loan. That gives you the breadth to like add more capital, make more profit. Then you can split that amount over the years to pay. So it gives you more opportunity to use capital to do other things instead of paying debts. And 2, the last one, they're paying 2,000 from Sally's bank. Yeah. Take money from your personal account. Those are the 2 options you have when you're having short-term liabilities and you don't have cash flow.
Yeah.
Is it clear?
Yes.
So the answer is 3 and 4, which is D. Question 33. Company X and Y, company Y provided the following information. Gross profit margin for X and Y. Company Y has more gross profit margin than company X.
Yeah.
That should mean that the profit margin for company Y should be more than company X. Do you get it?
Yeah.
But if the profit margin are now the same, it means company Y is having more expenses.
Mhm.
Do you understand?
Yeah.
Maybe it gives more discounts.
Yeah,
It allows more discounts. That would have caused it. Or it does a lot of overheads.
But it does have larger facilities and rent, more rent.
Yeah.
As a fixed cost, yeah.
Do you understand?
Yes, sir.
So the answer is C.
Yeah.
Question 34. The current ratio, which is current assets divided by current liability, is this. So X is having more current liabilities than Y. That is what the point is. So this would basically mean that X has more liquidity than Y.
Yeah.
Clear? That's 34B. The last question, they said, which international accounting objective, that's IAS, are described by the following statements? Information in the financial statement must be free from material error and bias. That's reliability. Yes. Users must be able to identify differences and similarities between information in different financial statements. That is comparability. So statement 1 is reliability. Statement 2 is comparability, which is B. Is it clear?
Yes.